President Trump's tariff policies got a little more confusing over the weekend, leaving investors once again uncertain about the market outlook. Our next guest has sectors that are currently offering safety and also has ones to avoid. We are joined here by Eric Beyrich. He is Sound Income Strategies Co-Chief Investment Officer. Eric, great to speak with you this morning. You say that you have to stay in bunker stocks. It feels like what a bunker stock is keeps changing in this environment. How are you defining that right now?
Yeah, actually, I agree with Tom. You'll make more money buying the bombed out areas than the bunker stocks. But for our investors who are mostly retirees that want income, we stay in the utilities areas a little more staples, just because there's less volatility and more income. But you should always look at the areas that are getting hurt the most for the biggest upside. Right now, I was just talking about stability, areas where it's safer for people and they can sleep at night.
And talk to me then about the most beaten up area of the market in your view on a sector basis. Which one is the most attractive?
Well, attractive and beaten up aren't necessarily the same thing. I think the materials are getting hit the worst, and they have the potential most upside. But remember, as people slow down their order rates to build goods, one of the first areas that gets hit are materials and also energy. We saw oil prices break $60 on the downside. That's going to have significant ramifications if there isn't a rebound. It's a function of both OPEC reconsidering people who have violated their agreements and also demand slowing down, partially due to this uncertainty. So those areas are the two most affected and most at risk and potentially have the most upside coming back.
And Tom Hayes is still here with us. Tom, you had some similar thoughts to Eric on that front. Do you have a question for Eric?
Yeah, I absolutely agree with you. On the materials side, absolutely bombed out. We're looking at, we kind of share an affinity here. I can tell you have a value tilt to you. We're looking at Albemarle, for instance. They got $3 billion of excess liquidity. Are there any materials names that you're looking at, Eric?
Well, we own a bunch of them. One that I really like that a lot of people don't because of they're afraid the dividend will be cut is Dow Chemical, which is one of the best companies in the world. Unfortunately, they have had their, and Lyondell, a similar company also in plastics, have seen their demand come down a bit. But I think over a long period of time, those are two companies that you definitely want to own. They're both high-yielding stocks, and they have substantial capacity for rebound, both in their margins, volumes, and earnings, as well as, of course, cash flows. Yeah. So those are.
No, I'm sorry. I just want to get one more stock pick from you because to that end, Eric, you talked about Corebridge as well, and you're not the first investor who's come on talking to me about how they like annuities right now. Can you tell me a little bit more about that name?
Yeah, Corebridge is basically the spin out from AIG that's focused mostly on annuities and life. And the stock is extraordinarily cheap, partially because of the overhang. AIG still owns over 20%, and partially because people don't know how annuities are going to do. They've been extremely strong over the last couple of years as interest rates have come back up and people want to buy annuities where they had avoided them when interest rates were low. But we see them continuing to benefit from a flight to sort of safety. So Corebridge trades at a little bit over 5 times earnings. Pure life companies typically trade closer to 9 times earnings. So there's tremendous scope for multiple expansion. It's generating double-digit earnings growth. So there's a combination of both the earnings growth and the multiple going to a normal level. We actually think the stock can double over a 2-year period. It's just a matter of them proving out that they can continue to deliver the goods. As any company that you've seen spins out, you see some moving abouts in their accounting numbers that it's crystal clear. As that stabilizes, it's going to become a safer investment for people and I think a better performer.
Eric, I got to know about ADT. This thing has been a value trap forever. Before it went private, now since it's gone public again. Give me the growth story. Why is this thing going to come out of this range? Why is this not going to be a value trap? I want to believe. Talk to me, Eric.
That's very easy to sell ADT now because they sold their commercial business, they deleveraged the balance sheet, and their earnings are growing now. Their margins have expanded from the mid-teens to the mid-20s. So you have about 5% top line growth, and you're going to have double-digit earnings per share growth. They're getting almost 100% free cash flow to earnings, wow. And they're buying back stock. So you've got a few catalysts. You have a relationship with State Farm, which is giving policyholders a discount to go with ADT to have an alarm system. And you have the Google partnership, technology platform that people like and they're adopting for smart homes. So you see a lot of different things coming together at once. The balance sheet is fixed, their business is growing, They're generating tremendous free cash flow, and they're deleveraging, and plus the overhang from the LBO is going away. So this is another situation where you get a decent yield, 2.9%. You get double-digit earnings per share growth, and you get a multiple expansion. It's currently trading at 9 times earnings. Normally, a subscription business like this will trade at twice that multiple.
Fantastic.
All right, Eric, thank you so much. We got to leave it there. Thank you.